You may be wondering, are venture capitalists basically role-playing Shark Tank or Dragon's Den pretty much every single day? We get to sit in fancy offices, roast startup founders, and remind everyone once in a while to chase for their dreams on LinkedIn, and when the time is right, we get to say,
I'm out. I'm out.
And for that reason alone, I'm out.
I'm out.
before doing it all over again. Whoa, okay. Whether it is to your greatest relief or disappointment, I can only assure you that VC investing is not quite like that. Well, I mean, I have never told a startup founder I'm out. Hey friends, welcome back to my YouTube channel. If you're new here, my name is Bianca, and in my experience working as an analyst at a VC firm so far, I have received a ton of questions with regards to how do venture capitalists typically evaluate startups before they decide whether or not to invest in them. So I thought, let's talk about this in today's video. So what I'm going to do is to just share a really high level and generic framework that I reckon most VC firms would adopt when they are going through their startup evaluation process. But just bear in mind that I said generic for a reason. Different VC firms and individuals would have different areas that they care about. So just like any of my other videos, just take my sharing as more of a guide rather than a rule. Let's get right into it. To begin with, I'd like to first separate the popular evaluation criteria that most VC investors use into three main buckets, and they are the deal, the business itself, as well as the team. So if we were to wear the thinking cap for evaluating the deal itself, the main question that VC investors are typically trying to answer is that, okay, is this actually a good investment opportunity based on the risk and rewards that we have identified? I mean, to put it in a really simple way, the main goal of any types of investment is to hopefully generate a high return on investment. This brings me to say, well, there are always times in which an investor will have come across a startup that's actually running a really good business, but let's just say for whatever reason, the founders are trying to sell their equity at an overpriced value, then they may not necessarily be a good investment. With that said, so what are the different areas that VC investors tend to look at when they're trying to evaluate the company from an investment opportunity lens? Well, at the very least, I can think of these. First of all, does the business align with the fund's investment mandate? Basically, whenever VCs raise funds from limited partners, aka other investors, one of the key things that they will need to come into an agreement on initially is the type of startups that they are allowed to invest in. And that would largely depend on the LP's risk appetite as well as, well, preferences. I'll just put it that way. For example, if you're planning to start a fund that focuses solely on fintech investments, then biotech companies are naturally not part of your investment mandate. So unfortunately, you will have to reject biotech startups coming your way even if they are really good companies. Just as simple as that. Besides that, some other areas you probably need to think about is whether the startup is at the right stage of fundraising as well as in the right geographical region that aligns well with your fund's investment strategy. Or in another increasingly important area, does the startup align well with your fund's ESG policy? Moving forward, you will need to assess the startup's valuation, or in other words, how much is the company choosing to price itself? And especially amongst early stage startups, you will have to bear in mind that their valuation is largely influenced by a multitude of factors, such as, well, their profitability and revenue, the amount of traction that they have built, or perhaps even the brand image that they have created in the market itself, or even, say, the total amount of venture capital that they have actually raised thus far. Next on the list, VC investors will also need to care about whether the startup that they're investing in would be capable of returning a VC fund. And this matters a lot because at the end of the day, a VC fund would be able to successfully raise money from their limited partners if they are able to show some evidence that they are capable of essentially returning their funds within 8 years' time whilst growing it at a magnitude of, I would say at the very least, 2 to 3 times. And because of this thinking cap that VC investors need to wear, it wouldn't be too surprising to see investors having to just give a rough estimate on their potential returns on investment and the base case, their best case, as well as the worst case scenario. Other than that, I wouldn't be too surprised to see VC firms also trying to evaluate the potential synergies that the startup may offer to their portfolio companies. And to some degree, also don't be too shocked if you find out that the VC firm you're pitching to has actually spoken to other VC firms about how they think about your company. Like, for example, I would say it is fairly common for VC firms to talk to their peers who may be investing at a later stage than themselves. Come to think about it, VC investors would eventually need to find a way to cash out on the investments that they have made. So if the downstream investors who may potentially buy out their stake are not really keen on the specific industry or startup that they have invested in, then it will be fairly natural for investors to think twice about investing in that particular startup. This kind of brings me to say that another key area that VC investors have to think about would be the potential exit opportunities that the startup would be able to enjoy. Where the popular types of exit opportunities that startups would typically face would be either getting an M&A or mergers and acquisitions, or enjoy a secondary buyout, or even potentially be publicly listed. So to put it simply, VC investors just have to care about exit opportunities because they will need to just find a way to liquidate on their position in the company, as well as recoup the funds for them to generate hopefully a high return on investment. Not to mention, every single investment opportunity, it doesn't matter how good a company is, will come with its share of investment risk. And investment risk can come in a myriad of forms, whether it is related to the macroeconomic condition or if it's something that is internal. So let's just say from an execution or financial or even a legal angle. With that said, there are just two very simple questions that VC investors would need to answer. So first of all, are they able to hedge themselves from all these identified investment risks? And number two, so with all these investment risks, can they live with it? So just like in a romantic relationship, if you can't stand the other party's weaknesses, don't tie the knot. And lastly, okay, this is oftentimes the tiebreaker question that my company loves to ask. And that is, would you personally put in your own money into this startup? I mean, it could be really easy for someone to build a very compelling investment thesis to convince their VC fund to put money into this startup. But if they themselves aren't able to show this personal conviction that this startup is going to succeed, then it doesn't quite make sense to basically ask people to throw in their money into the startup. I don't know, I just for some reason find this a very counterintuitive strategy that I could adopt whenever I'm trying to just decide if I'm going to spend the next 2 weeks of my life building an investment memo. Right, on to the next bucket, the business itself. I would say that the areas VC investors typically look at are fairly similar. Number one, the problem that the startup is trying to solve. As how Y Combinator Startup School puts it, VC investors simply love problems that are able to take either one of these boxes, or in a super ideal scenario, a lot of them. The problem has to be popular, growing, urgent, expensive, mandatory, or even frequent. Besides that, it would be great if the entrepreneur can also explain why the current solutions aren't exactly the best fit for solving the problems that the customers are facing. Having mentioned that, it wouldn't be too surprising for VC investors to, following that, spend a great deal of time simply scrutinizing the startup solution. Basically, I would say that the main questions that investors are trying to answer would be the following. So first of all, has the product market fit been demonstrated? And number two, is there a very unique value proposition that the startup solution is able to offer? And number three, how scalable is this idea? The answers to those questions, well, to some degree, can be answered by the operational and financial traction that the company is able to present. Financial, well, are customers actually paying for that solution? Or in other words, is the company actually bringing in loads and loads of revenue? Operational wise, well, this is largely going to depend on the different KPIs, aka key performance indicators, that the company has established for itself. And this is going to be greatly based on the nature of their business as well as the industry that they're operating in. Most of the time, or at least based on my experiences thus far, I would say that the typical KPIs that a company chooses will be largely based on the firm's, sales or marketing or project management efforts. For example, if the VC investors are looking at an education technology company that has actually built a mobile app for regular people like you and me, then I would say that a very classic operational KPI that VC investors would scrutinize would be the total monthly active users that the company has managed to gather. Not to mention, the kind of KPIs that the company tracks will also need to align with the long-term, strategic objectives that the management has set. Meanwhile, the point to that scalability question is for VCs to just figure out if this startup can grow into this humongous business in the long term. Okay, as in big enough so that it can generate a meaningful exit. On that note, part of that scalability question can also be answered by the company's business and revenue model. To keep it simple, the whole point of scrutinizing those two angles is to basically figure out if the company would be able to make money as well as scale its operations efficiently. So I would say that it shouldn't be too surprising if you come across VC investors just doing a lot of site visits or calculating the company's burn rate, or even having a long debate with the founder on the viability of, say, their 5-year revenue projection. Moving on, I would say that it is fairly natural for VC investors to also care about the market that the startup is operating in. The point to that is to know if the market is huge and just growing in size. And if at any point in your life you find yourself working in a VC firm, I am willing to just bet money that you will come across this diagram at some point in your work life. So startups would usually try to break down their market sizing process into 3 key components. So first of all, the total addressable market, or TAM for short, which basically describes the total amount of demand existing in the market for their solution. And this is followed by the serviceable available market, or SAM, which is the specific segment of the market that the company addresses. And this, last but not least, leads to the serviceable obtainable market, or SOM, which is the percentage of the SAM that the company could realistically obtain. Long story short, VC investors love billion-dollar TAMs. So if you want to get VC funding, I would say you just gotta make sure that your market is large enough to suit their appetite. Next in line, I would say it is also pretty important for the VC investors to figure out if the company has basically a wide economic moat, or in other words, a competitive advantage. Key reason for that, I would just put it this way. In any billion-dollar markets, there will always be multiple companies just trying to vie for the same customer groups. So you could imagine that the main questions VC investors would be seeking out answers for would be, number 1, who are the direct competitors or substitutes they are operating in the same space that the startup is in? And number 2, what makes the startup in particular differentiated and better than anyone else who is trying to solve the same problem? And this is followed by number 3. Okay, so what's stopping anybody from just simply copying your idea and entering the market? So for the best of the best companies out there in our world today, I would say that it's pretty easy for you to notice that they will have at least one of these key economic moats to sustain themselves for the long term. Examples of this would include stuff like a brand monopoly, a really strong economies of scale, or a high entry barrier, as well as all these network effects that platform-based companies would typically have, or a really expensive switching cost that most software as a service company would typically possess. Now, arriving to the final, yet the most important bucket of all, the team itself. In short, building a successful company is not just about having the right business strategies or skill sets, it's mostly about having the right people running the company. This leads me to say that VC investors would need to scrutinize this aspect the most. And how are they going to do this? So one way is to understand the founder's story. I mean, for me at least, I don't know why, but anytime that I find myself meeting an entrepreneur, I tend to have this question in mind, which is like, of all the things that you could be doing with your life, so why are you and your team so passionate about the business that you're building? It's like, why do you care about this problem so much? And why are you the best person to build and scale this company? On top of that, another really important area that the VC investors will need to figure out would be the founders' unfair advantages. Maybe it's for certain VC firms, but I kind of noticed that this sometimes is truly the make or break question about whether they think this team is a good team to invest in. Reason for that? Well, this is basically to answer this key question. Why is this team going to be a winner instead of anybody else? What do you have that other people don't have? So why are you going to be the fastest at growing? All these insights will be needed for a VC firm to be convinced enough to pick you over anybody else. And mind you, these unfair advantages still at the end of the day have to relate to the company's growth. And as explained by Y Combinator's Startup School, some of these many types of unfair advantages could be as follows. So they may include things like the founders themselves, like, are you the right person to solve this problem? Or do they have this previous experience in the field that they are building a company in? Or it could be, say, the market. So is it growing massively every year? Or even say the product, where maybe the product is 10 times better than the competition. Or even say the customer acquisition approach, where it could be, well, ideally free of charge, or aka done via word of mouth. Or alternatively, the company has this special monopoly. So as your company grows, it just becomes way harder for competitors to beat you. Last but not least, VC investors will need to determine if they can work well with you. Assuming you have watched shows such as Shark Tank, you may have noticed that some investors may have dropped out in the middle of a deal negotiation, saying that, well, something in their gut tells them that they are not going to be working well with the entrepreneur. And as much as how silly or even, say, irrational that kind of excuse may sound, I actually honestly would even argue that that's actually a valid reason. Because at the end of the day, you are going to have to work with the entrepreneurs to grow the business. So if you're going to spend the rest of your life, or at least your time together, hating and fighting with each other, that is kind of missing the point. Besides that, VC investors will also need to, well, convince themselves that that startup founder is the right person to be the CEO of that company. And some of the popular traits you can imagine investors love is that these founders would be extremely visionary storytellers as well as leaders, and they should be really self-aware, data-driven, humble, and just really financially savvy and good at managing relationships. With that said, this brings me to the end of this video, where I hope that I have managed to help provide some insights on how venture capitalists typically evaluate startups. But of course, I really hoped that you also understand that even with this framework in mind, it is still very possible for VC investors to still make the wrong bets. And that's simply because VC investing is just a combination of arts and science. Investors would usually make their decisions after doing a lot of pattern matching and a lot of, say, due diligence processes and research, as well as just relying a bit on their previous experiences and just personal understanding of an industry. But at the end of the day, anything can happen in the future and no one has any form of certainty about that. So you kind of just have to be at peace with that, well, uncertainty. On that note, thank you so much for taking the time to watch my video. If you thoroughly enjoyed it, I really hope that you could just hit the like, subscribe, and bell icon to help my channel. Wherever you are, I'll just simply thank you from the bottom of my heart for that. And if you happen to be someone from a non-finance background who's hoping to break into the VC industry, I have actually made another video where I shared a bit more about why I actually believe that your technical background could be your unfair advantage. So do check that out if you can, and I shall see you in my next video. Bye bye!